There is one line in one slide deck that cost America's 7 biggest companies close to $800 billion on Thursday. It was not a profit miss. It was not a warning. Nobody got fired over it. It was a single guidance range nudged higher, and the market read it as a threat. I will tell you exactly which line, and why 4 more companies read from that same page on Wednesday and Thursday of next week. But it only makes sense once you see why one chipmaker steers this entire index. Nvidia is now roughly 8% of the S&P 500 by index weight, the largest weight any single stock has carried in the index since the data begins in 1981. That is Apollo's chief economist, Torsten Slok, and he did not hedge it. One company, bigger than the entire energy sector. Bigger than utilities. Start with the plumbing, because the plumbing explains most of it. When one name gets that large, it stops being a holding in your portfolio and starts being the weather. The S&P 500 is not a diversified index anymore. That is Slok's conclusion, not mine, and here is the arithmetic behind it. As of May, his read was that the top 10 holdings account for about 34% of the whole index. So if Nvidia moves 5% in a day, it pulls roughly 0.4% out of the index on its own before a single other company's shares have traded. Nvidia has not been leading this market higher. That is the part that breaks the standard story. Through early July it was up around 5% on the year, while the S&P 500 was up close to 10%. Microsoft, as of last week, is down roughly 18% year to date. So the most valuable company on earth, worth just over $5 trillion, has been steering the index mostly sideways. By mass, not by momentum. For companies, Microsoft, Amazon, Alphabet and Meta plan roughly $725 billion of capital spending in 2026. In 2025 the same figure was about $410 billion. That is a 77% jump in 12 months, and the overwhelming majority of it lands in data centers. That is how one chip company got this heavy. Follow the money, because the money moves in a circle. Amazon is guiding to about $200 billion of that spending. Microsoft is tracking near 190. Meta sits between 115 and 135 billion. Now put Nvidia on the other side of that ledger. It guided this quarter to $91 billion of revenue, give or take 2%. Annualize it, and one company's sales are running at roughly half the combined capital budget of the 4 biggest spenders on Earth. The demand is real, not a narrative. Last quarter Nvidia reported $81.6 billion in revenue, up 85% from a year earlier. The data center segment alone was $75.2 billion, up 92%. Those are not bubble numbers on an income statement, which is exactly what makes this week's selling so interesting. Nobody sold because the demand vanished. The demand is the whole problem. They sold because of what the demand costs. And here is where it gets genuinely strange. Alphabet reported Wednesday after the close, and it was a quarter almost nobody could criticize. Revenue of $119.8 billion, up 24%. Google Cloud up 82%. Operating income up 30%. The cloud backlog grew by more than $50 billion in 3 months, to $514 billion. Then came the capital spending line. Alphabet raised its 2026 capex guidance to a range of $195 to $205 billion, up from $180 to $190 just 1 quarter earlier. $15 billion added at the midpoint, in 90 days. The stock fell about 5% after hours and shed roughly $300 billion in market value. For spending more, Alphabet's finance chief, Anat Ashkenazi, told analysts the company is pulling capacity deliveries forward, because demand for cloud AI infrastructure still exceeds available compute. Supply, she warned, stays tight into 2027 when spending rises again. Same run of results, Elon Musk told Tesla investors that 2026 would be, in his words, a massive capex year, while profit came in well below expectations. Tesla lost roughly $200 billion. Amazon fell 4.6% in sympathy. The market punished the buyers and left the seller alone. Nvidia closed Friday down under 1%. Alphabet, Tesla, and Amazon absorbed the damage. 2 years ago, every dollar of announced AI capex was read as future Nvidia revenue, and the whole complex rallied together. Today the same dollar is read as somebody's free cash flow disappearing. Identical fact. Opposite reaction. Nvidia's order book is somebody else's cash burn. That is the fragile joint in this machine. Microsoft's capital spending climbed 49% year-over-year last quarter, to $31.9 billion, while its free cash flow fell 22%, to $15.8 billion. The buyers are financing the sellers' growth straight out of their own margins. That works right up until the board meeting where somebody asks how long. Which brings us to next week, and the calendar is stacked. Wednesday afternoon the Federal Reserve delivers its decision, with rates sitting at 3.5 to 3.75%. Futures put roughly 2/3 odds on a hold and about a third on a hike. Not a cut. A hike. May's consumer price index ran 4.2% year over year, a 3-year high, and the 10-year yield closed Friday near 4.68. Then the results land. Microsoft and Meta report Wednesday after the close, Apple and Amazon Thursday. Consensus has Microsoft near $87.7 billion in revenue, but that is not the number that moves the stock. Analysts are hunting for fiscal 2027 capex guidance somewhere around $220 billion. And Thursday morning brings second quarter GDP and the June PCE inflation print, back-to-back before the open. And here is what most people miss about next week. Nvidia does not report until August 26. But its forecast effectively gets published on Wednesday and Thursday by 4 other companies. Every capital spending line that Microsoft, Meta, Amazon and Apple read out loud is a line item in Nvidia's future order book. Next week is Nvidia's earnings report, delivered by its customers. So what actually matters while you watch it? First, the direction of capex guidance, not the level. Everyone already knows the numbers are enormous. The real question is whether even one of those 4 trims, delays, or starts using the word efficiency where it used to say expansion. A single trimmed number would do more damage to the AI trade than anything the Fed says on Wednesday. Second, watch cloud revenue growth against capex growth. Google Cloud grew 82% while its capital spending grew 107%. When the spending outruns the revenue it is supposed to create for too many quarters in a row, patient money stops being patient. Third, watch the reaction, not the print. Intel beat Wall Street's expectations on Friday and still fell more than 6%. Bank of America's bull and bear gauge is at its highest reading since 2021. That is positioning, not fundamentals. And that line I promised you at the start, the one that erased $797 billion in a day. It was not a miss. Not a warning, not a scandal. It was Alphabet moving its capital spending range up by $15 billion. That is the whole event. A company said it would buy more. Next week, Microsoft, Meta, Amazon and Apple all read from that same page. Nvidia will not say a single word and it will still decide where the index closes on Friday. That's all for today. If you found this useful, like, subscribe, and share it with someone who'd care. Catch you next time.